Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 308 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So, good morning, Matt. What is going on in your neck of the woods this week?
Heat and rain. That's what's going on, right?
Yeah.
Market volatility's come in nicely over the past couple of months, so it turns to the weather, right? Is that how this always works, Mark?
Yeah, if it's not one thing, it's definitely something else. But before we get into this week's show, if you have been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I would encourage you to head to our website, jessupwealthmanagement.com, where Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select the time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on July 9th. S&P 500 index up 1.05% so far in July and up 6.49% for the year. Dow Jones Industrial Average down 0.08% for the month and up 4.5% for the year. The NASDAQ Composite Index up 2.02% for the month and up 6.73% for the year. The Small Cap Index, Russell 2000 Index, up 2.5% for July and up 1% for the year. And the Vanguard All World ex United States ETF up 0.36% for the month and up 17.52% for the year. Moving on to big headlines and current events from this week, Matt. Last week was the jobs report for June. So it came out that the U.S. added 147,000 jobs in June, beating expectations of 110,000. And the unemployment rate dropped to 4.1% from 4.2%. So still not seeing much of a slowdown at all in the jobs market, which is great from an economic standpoint, because I know, there were quite a lot of people earlier this year saying that at some point we were going to fall into a recession in 2025.
Yeah, and I think investors got to equivalent that to what's the health of the American consumer. And the data is showing that overall, they're not bad or as bad as they had feared earlier in the year. And so from an investor standpoint, your next real-time check-in in that data is going to be Q2 earnings from these retailers. So you're going to want to kind of see, what's the Walmarts, the Targets, the Costcos, the Amazons, what are they kind of saying about the consumer? What about Visa and MasterCard? We've talked about that in the podcast with their data. If you remember when we were talking about those Visa earnings, not a recommendation for or against Visa or any of the other names that I just mentioned, but when they were talking about their read-through in the American consumer, when that data came out at the end of April, that was not bearish data. And look what came to fruition in the markets the rest of Q2. So I think we got to keep our ears open to that data.
Yeah, good point. We're going to start seeing earnings start to slowly trickle in at the end of next week, with the banks starting to report for their previous quarter's numbers. Last thing is, obviously, Matt, the Trump administration's big, beautiful bill was signed into law last week. And this is something that we will be discussing later on in the podcast with the financial planning topic of the week, to go into the specifics of this bill and how it may affect listeners and investors. So more to come on that subject here in a little bit.
Great.
Moving on to tweets, articles, and research from this week. The first thing I had was a post on X from Ryan Dietrich on July 1st. He says the S&P 500 gained more than 10% in Q2. What happens historically after 10% quarterly gains? The next quarter is higher 85% of the time, and 2 quarters later, stocks are higher 85% of the time. Another clue that the rest of 2025 could be a good one. And I think that this just goes back to the fact, Matt, where there's so much information out there about this, sell off and recovery being so quick, one of the quickest recoveries on record, from being down over 20% intraday back in early April. I think naturally people are like, there has to be some sort of pullback at some point in time here. And I agree that there can be, but it doesn't necessarily mean that there has to be. And that pullback could just be 2, 3, 4% in the market. It doesn't need to be a 7 to 10% pullback. So I think this data does a good job of explaining kind of the strength begetting strength in our industry. And when times are usually good, usually there's better times ahead.
Yeah, I mean, to echo that, you said it very well. Now I'm going to say it more simplistically. People don't like to buy stuff after it moves, right? They try to apply their personal spending psychology to investing, which is, well, I only want to buy it if it's a deal, if it's on sale. And the problem is they're looking at the recent price movement. And if XYZ stock went from 10 to 12, they're thinking, I would really like to buy it at 10. And it could go back to 10. It may not.
All right. Might not
So,
get the opportunity.
yeah, I think I have some other data points that support the actual fact that market strength in the market environment tends to be better when the market's hitting highs.
Very good. Looking forward to that data. So next post was another one from Ryan Dietrich. This was just a day later on July 2nd, another post on X, kind of along the similar lines, Matt. He said greater than a 10% gain in Q2 after being down in Q1. Q3 and Q4 have never been lower, up nearly 16% the final 6 months of the year on average. So again, this is a piece of data where the sample size is not very large. So there's only been 1, 2, 3, 4, 5, 6 times. 2025 was the sixth time that that Q2 had a greater than 10% gain after being down in Q1. So anything can happen, but up until this point in similar scenarios, if we look throughout history, going back to the late 1960s, returns for the rest of the year look pretty good. So, again, I think there were a lot of people that got it wrong when they came into the year super bearish and then doubled down on that bearish bet after, the market action we saw in early April. And, I'm not trying to toot our horn or anything, but I think we were pretty straightforward on what we thought this year was going to bring, and we thought it was going to be a pretty average year by the time December 31st rolls around. Because if you just look at it from a calendar basis, post-election years tend to be pretty average, and then midterm election years tend to be pretty poor. And what are we going into in 2026? A midterm election year. So, I think people might be pleasantly surprised with how the rest of the year plays out. Because again, all of the data, at least that I'm looking at and taking in, is definitely weighing more on the bullish side, that the rest of this year could be pretty strong.
Well said. I feel that there is still a lot of pessimism in the market when you look at sentiment surveys. Still a tremendous amount of cash on the sidelines. I saw a post this morning. I'll highlight it on the podcast next week formally. Money market assets hit another new all-time high. But wait a minute. How can cash on the sidelines be hitting an all-time high when the market is? Interesting I wonder if that money is going to be happy earning 4% or so a year when the market continues to do well. I wonder how much patience that cash is going to have.
Yeah, and that kind of is a nice little segue into my last piece here, Matt.
Am I unknowingly teeing you up?
It is. It's having to do with the next Fed rate potential Fed rate cuts coming up at the end of this month at their meeting. So this was a snippet from a blog post from Tom Bullish titled "All-Time Highs and an Upcoming Rate Cut. We're just getting started on this move higher." This was on stockcharts.com back on June 27th. So if Tom is correct on this, Matt, people might not even be getting possibly 4% on money market funds going forward to the rest of the year. So he has a blog post about this. I just want to read, just like I said, a little snippet of it. So he says, "It's coming and it's coming fast. I'm now convinced that the Fed will cut the Fed funds rate in a month at their next scheduled meeting on July 29th through the 30th. I'm not saying it because I feel the Fed should cut or needs to cut. I'm saying it because there's a ton of buying right now in the 1-month Treasury, sending its yield down. The 1-month Treasury yield typically begins to move before any Fed action occurs. We saw it back in August and September 2024, just prior to the 50 basis points cut at the September 2024 meeting." So Jenna will throw this chart up on the YouTube page that Tom is referencing. But as you can see, the 1-month Treasury yield falls pretty substantially before the Fed cut rates the last couple of times. So, and you can see now the 1-month Treasury yield is falling. And as we talked about, several times on this podcast, Matt, there is that inverse relationship with bond prices and bond yield. So when one is going up, the other is going down. And we are seeing a lot of people buying the 1-month U.S. Treasury right now. So it piqued my interest enough just to check what the odds were of a rate cut right now at the end of the month at their meeting on July 29th and 30th. What do you think the odds are that they're going to cut, Matt? Right now, the current target rate is 4.25% to 4.5%. So what do you think the odds are that they're going to cut to a target range of 4% to 4.25%?
At the July meeting?
9%. 6.7%.
The reason I knew this, it's one of my pieces this week.
Oh, perfect. More interest rate thoughts. Tends to happen more often than not with me and you. But
focus on that though for a second, because if only 6 to 9% of market participants are expecting a cut and we get it, how's the market going to react to that?
Right. No, it's a great point, and I think I had a piece on this like a year ago or something, but it was something along the lines of every time we're a week away from the Fed funds meeting and announcement, whenever there's like more than 90% probability that there is going to be a cut or isn't going to be a cut, it has happened 100% of the time. So we would need a big swing, I think, in probabilities between now and the end of the month to see a Fed rate cut. But there's a first time for everything, and it could be one of those situations that just completely catches everybody off guard.
All right, I'm going to blend it together with the point I was going to make with this topic, because this is perfect, Mark. If you think of the Fed fund futures the last couple of years, the market, for the most part, has been very wrong on the trajectory of interest rates. Now, I'm going to explain that in plain English for our newer listeners and viewers. If you think of the last roughly 2 years, most market strategists and economists were conveying projections that interest rates were going to come down actually quicker than they did, or they have so far. So let's just now say it more direct. For the most part, Wall Street's been wrong on this. Now, the next question is, with the projections they have, you're still hearing the same narrative. interest rates are going to come down a lot over the next 18 to 24 months. Now, do I think that they're going to come down? I do. But part of me thinks they're going to come down slower than the market's anticipating. Why is that? Underlying economic strength is there. Now, next week's going to be interesting, Mark, because we're going to get inflation data on the 15th. And a lot of people are clamoring that, oh, it might show the hints of some of the tariff issues might start to peek itself into the inflation data. I haven't seen it anywhere else. Not saying it can't, but I'm just in this camp that, yeah, I think interest rates are going to start to come in over the next 6 to 12 months, plus another 12, so 24. But I'm just not in the camp that they're going to come down as quick as the market expects.
Yeah, and this stuff just changes, so often. It's so fluid because coming into this year, everyone was expecting a lot more rate cuts by this point in the year, and we haven't had that yet. So this stuff can change, on a dime.
Yeah, and remember, listeners and viewers, market loves cheaper money. So the market tends to react positively to these rate cuts because money becomes cheaper in the system and fuels economic activity. That's why the market would react positively, most likely, historically, if we get that rate cut at the end of July.
Yeah, it's a good, simple explanation. So that's everything I had, so I will turn it over to you.
All right, pivoting back, Mark, to your point about the market hitting highs and how it acts going forward. I know you shared some data from Ryan Dietrich. The first piece I'm going to highlight is from Tier 1 Alpha, and they posted this on June 30th. And Jen will put up this illustration for our YouTube viewers. This will be in our show notes. What this chart illustrates, Mark, is S&P 500 all-time highs from 1970 to present. And what Tier 1 Alpha did is every time the market hit a high, you're going to see kind of a red dot. And it visually is showing you that strength begets strength. You're seeing that fuel the market higher. So I'm going to take an arbitrary period, okay? I'm just going to pick one that stands out, which is about 1995 to about 2000. My point here is that was a favorable 5-year period for the market, but it didn't come without challenging quarters during that time. And one that stands out with me is the Asian financial crisis in 98. You had a period of time where the market corrected pretty sharply. Now, it was a V-shaped recovery. So I think sometimes when charts like this are shown, it makes it appear it's just an easy peasy to buy a stock and hold it, and it's going to be, no stress and low volatility. Not necessarily the case. But the point I want to make with this chart, though, is that typically from a historical lens, when the market is hitting an all-time high, it's not necessarily bearish from an equity price standpoint. Mark, any further comments before I move on, sir?
Yeah, it's just that, it's one of those things where if you get an all-time high, there's, on any given day of the week and the given month that we're in, there's a pretty high probability that that's not going to be the only all-time high for that week or for that month, like this chart shows. And the other thing I want to point out is that people have done research studies on this and back tested strategies of solely buying the market when it hits an all-time high and only doing it when it hits an all-time high and holding it for the next year or the next 2, 3, 4, 5 years. And it actually turns out to be a pretty decent strategy, actually better than trying to catch falling knives. So, it's one of those things in our industry that I feel like we have a lot of these, but when you think one way or think one thing is going to happen, the opposite is actually true. And I think this is one of those scenarios that, most people look at it as, hey, the market's at all-time high. I don't want to be buying stocks at an all-time high. Well, Matt, looking at this chart, there's an all-time high in 1972. Are you telling me you didn't want to buy stocks at that level in 1972 and have them still today? Right?
Right.
So it's just this is the all-time high as of today. But if
All right.
you look 10 years down the road, there's going to be yeah, I'm just going to guess hundreds of more, maybe thousands of more all-time highs 10 years from now.
Well said. And I think there's another overlay that is not talked about enough in the market. It's inflation. If we think about these real assets, let's just take stocks as the example. If all things are equal, stocks should have a tailwind with inflation. I know we're about to talk about at the end the new spending and tax bill that was passed. Let's face the reality of it. I don't care what party is in office, most likely both parties are going to continue deficit spending, which
Yeah.
is going to lead to a tailwind of inflation. Okay? That within itself should provide a tailwind for asset prices. And you know what? Not enough people are talking about it.
Yeah, totally agree. That's a whole nother ball of wax that we could get into at some point in time,
Sure.
but we'll stay on track for today.
All right, my next thing is from Evercore ISI. This was posted by Seth Golden, friend of the podcast, July 8th. What this piece is about is Julian Emanuel of Evercore ISI noted that since 1960, Mark, there have been 6 times where the S&P fell peak to trough about 20% without the economy entering a recession. Okay? So let's real quick go back to February, March, and April. The market was pretty certain we were going to have a recession later this year. That's why they sold the market off as hard as they did. So Julian goes on to show in a chart, and I'm going to verbalize this because the chart's a little grainy. It wouldn't be a high enough quality for the podcast to post it on our YouTube or our social media. But on average, stocks gained 26% over the next 18 months, and after already the S&P having made new highs. So again, when you have the market correct like this, we got to remember Wall Street is infamous about shooting first and asking questions later. Well, I think a lot of Wall Street's got some egg on their face because there was a lot of selling in March and April, and that base case scenario of a recession doesn't seem to be in the cards this year as of right now, which is why you're seeing the market act the way it is most recently. Just want to throw it out there. Again, I'll say it, on average, in those 6 instances, the S&P gained 26% over the next 18 months after making new highs. I'll throw out some years where this occurred, and I'll move on. 1961, 1966, 1967, 1996, 2018, 2022, and now. Okay, I remember 18. We had that correction in the fourth quarter, very quick correction, about 20% in 3 months. Not fun.
Yeah.
V-shaped recovery thereafter.
I remember that. Yeah, that was one of those instances where I remember what I was doing when it was like at its worst.
Yeah,
Well, it
not
wasn't
fun.
fun.
Not fun around
No,
the holidays that year, huh?
no, it was not. Yeah,
No.
December, not a
I
fun time.
I steal the line from another historical Wall Street cat. The ice cubes didn't stand a chance that Christmas. I'll tell you that.
Yeah, there was no holiday cheer that December of 18.
So the last piece I had, and I'm going to glaze over it because we talked about it, is what I call this Fed rate monitor. So if anyone's curious to see these stats about how the market's pricing in where the Fed funds rate's going to be, you can access that data for free. We get no incentive or to mention this website. I just want to share it with people. You can go to investing.com and they have something called a Fed rate monitor tool that you can access for free. Again, we have no conflicts of interest to throw that out there, not a recommendation for or against anything else on that site. But they have something called the Fed rate monitor tool. It says, and I quote, our Fed rate monitor calculator is based upon CME Group 30-day Fed futures prices, which tend to signal the market's expectations regarding the possibility of changes to U.S. interest rates based upon Fed monetary policy. The tool allows users to calculate the likelihood of an upcoming Fed rate hike or cut. So as we talk about the short term, I'm just going to talk about 1 year from now. So as it stands, when I did this on July 9th at 12:05 p.m. while I was eating my lunch, the expectation for my birthday, July 29th of next year of 2026, the median is expecting rates to be at 3.25 to 3.5. So 1% lower, roughly 1 year from now, than they are today. Again, market's been behind the 8 ball on this. We'll see if it actually happens.
Yeah, that's great. What are you turning 30 next year?
Yeah, absolutely.
That's what I thought.
Absolutely.
That's what I thought.
Absolutely.
Well, yeah, like we said, this stuff changes pretty quickly, but that would be interesting if we're just about a full percentage point lower by this point in the year next year. So
Yeah, I mean, last quick comment. Remember, listeners and viewers, we talked about this for a long time. The longer the Fed holds rates in the pace of cuts being slow in the lens
better
of
it is.
history, that's bullish.
Yeah, that's what you want to see. If you've been in the camp that they thought they should be cutting to 2%, by now. If you look at the data, and we talked about it, you've brought it up several times in the past year or two, the slower and steadier the rate cut cycle is, the better it is for stocks. So, and I think we're seeing that, at least for right now, play out.
Yes, sir.
So, okay, wrapping up with the financial planning topic of the week. These are just some important provisions or important takeaways that I had from the one big beautiful bill, with some help from the tax advisor website. And this article was written by Alistair Nevius on June 29th. So they did a really good job of kind of summarizing the major takeaways. So what I did was kind of look at it from the lens of our industry, our clients, listeners of the podcast, to see what provisions in this bill are going to affect them and have implications on our industry. So I'm not going to read every single change, obviously, because we'd be here for a long time, but I'm just going to kind of highlight the important parts, at least in my opinion, that I think everyone who's listening to this should be aware of.
Love this.
So first, starting very high level with tax rates, Matt, the legislation permanently extended the lower individual tax rates enacted as part of the Tax Cuts and Jobs Act that Trump implemented in his first term, with the top bracket staying at 37% for the highest earners. And just to be clear, this is without a scheduled sunset. This is a permanent change.
That's a big deal.
To keep these lower tax rates. And it is, right? Number two, the standard deduction. So the bill makes the TCJA's increased standard deduction amounts permanent. So for tax years beginning after 2024, the standard deduction increases to $15,750 for single filers and $31,500 for married couples filing a joint tax return. And then after that, the standard deduction will be adjusted for inflation. And these changes have been made retroactive to include 2025 tax year.
Okay.
Next is the tax on Social Security. So this was something that was big on the campaign trail leading up to the election last year. So the tax treatment of Social Security has not changed in this bill. But instead, from 2025, so from this year through 2028, there's a new $6,000 deduction for people who are 65 years or older by the end of the year.
Okay.
So the deduction obviously doubles to $12,000 for married couples filing a joint tax return if they're both older than 65. But the deduction starts phasing out if you're single and your adjusted gross income is between 75 and 175,000, or if you're married filing joint and your AGI is between 150 and 350,000. So again, just to be clear, the tax treatment of Social Security has not changed, but there is a new deduction for people who are of Social Security age to help with that, if that makes sense.
It does make sense. Yep.
Okay.
I think that'll make a lot of individuals 65 and older happy. I don't care what side of the aisle you're on. I think that'll be welcome news.
And I think, yeah, I don't disagree with you. And I think it might be something that might be hard to take away if people get
Oh,
used
good
to it
point,
over the next
Mark.
several years, right? So I think
Good
if someone
point.
comes in,
Whoever takes that
whoever it
away is
is,
not going to be popular.
right. So it's like, it's one of those things like it's political suicide. You come in and you make it more expensive for older people in the population. So it'll be hard to take away regardless if there's a Democrat or a Republican president in the next term. So
You got
next
listeners and viewers. You got Mark moonlighting here as a political strategist right now. I'm all for it.
yeah, that's right. Exactly what I want to do. Next, probably the biggest or most talked about, at least in our industry, has been the SALT cap, so the state and local tax
Yep.
cap and the deductibility of that. So this bill increases the limit on the deductibility of state and local taxes to 40,000 per year from 10,000, but the increased cap begins to again phase out for people with more than 500,000 of income, and it's scheduled to revert or sunset back to the current level of $10,000 in 2030.
This is going to
Um,
be big for some states with high state tax rates, right?
again, yeah,
Connecticut,
yeah,
New
yeah.
York, California. Big deal for
So
them.
yeah, it is a big deal. So again, I think this is another thing that might be hard to take away here in the next 5 years, whenever this is set to revert to the $10,000 level. But at least for the next 5 years, nice for people that are paying hefty state and local taxes. So
Yep.
next is the child tax credit, and with a child on the way, very big fan of this. So it increases the child tax credit by $200 to $2,200 per child beginning in 2025. Estate and gift tax exemptions, Matt, permanently raises the estate and gift tax exemptions, which was scheduled to revert to approximately 7.1 million per person. And it raises it permanently to 15 million per person in 2026, which is another big deal for people that have accumulated significant wealth in their life. So takes away a lot of the estate tax burden on clients and their advisors. And then obviously just from a pure numbers standpoint, it makes a lot of sense. So I'm sure people are very happy to see that this was permanently raised, because I know, we've had conversations and we've had conversations with other advisors that people were spending a significant amount of time trying to run the fire drill on, hey, if this, estate tax exemption does revert back to the lower level, what are we going to do and what is the plan going to be?
Yeah, I mean, the jaded side of me sees this changing again sometime over the next, say, 5 to 15 years. I think that, it is a safe political point to be like, hey, we're going to tax the wealthy. And I think that this threshold, even though it's at 15 million per person, I'd be careful feeling that that is going to be truly in perpetuity or until they really need money.
Right, right.
I mean,
Which,
that's just the jaded side of me. That's the
yeah, I would
conservative
agree.
side of me
I would
speaking.
agree. I would agree.
Yeah.
Next is the mortgage interest deduction. So the bill permanently extends the TCJA's provision limiting the qualified residence interest deduction to the first 750,000 in home mortgage debt.
Interesting, Mark.
Yeah, very interesting. Um, Next, gambling losses. I thought this one was very intriguing. So the
I've heard
bill
nothing about this one.
Yeah, so the bill limits losses from wagering transactions to 90% of the amount of those losses. And those losses will only be deductible only to the extent of the taxpayer's gains from wagering transactions during that year. So it if I guess if you are a big gambler, this is kind of a negative, and it, I guess, might prohibit people from maybe gambling as much as they do, but I'm sure, the DraftKings of the world and, Wynn and, all these other publicly traded companies that are in the betting industries probably didn't love to see this, just because it's going to make it a little bit more challenging for those people. So,
Interesting.
yeah. Student loans. So this bill lowers student loan borrowing limits and narrows student loan repayment plan options. So, trying to, I think, tackle the ever-growing student debt problem in this country. No tax on tips, another big one that was talked about on the campaign trail last year. So the bill provides a temporary deduction of up to $25,000 for qualified tips received by an individual in an occupation that regularly receives tips. The deduction will be an above the line deduction and therefore available for taxpayers who claim the standard deduction or itemize their deductions. This deduction begins to phase out when the taxpayer's modified adjusted gross income exceeds $150,000 if you're single and $300,000 if you're married filing joint. This temporary deduction will be available for tax years 2025 through 2028. So again, I think there was some strategy in this, making it very difficult to take away some of these temporary provisions, in the next 4 years or at the end of a 4-year period, because there's a lot of people in this country, Matt, a lot of workers that make a lot of money with tips, right? So this is going to be something that's going to be very, very popular with whoever the next administration ends up being.
And tough to take away.
Very tough to take away. So next, along the similar line, no tax on overtime. So the bill provides a temporary, again, above the line deduction of up to $12,500 if you're single, $25,000 if you're married filing joint, for qualified overtime compensation received by someone during a given tax year. The deduction begins to phase out when the taxpayer's modified adjusted gross income exceeds $150,000 if you're single or $300,000 if you're married filing joint. The temporary deduction, again, only available for tax years 2025 through 2028. So these last two things are pretty big in my opinion, because you can still take the standard deduction in addition to these, right?
You're right. That's a big deal.
It's a very big deal. So definitely should be a net benefit to American workers. Two more things for you, Matt. Number one, dependent care assistant program. So the bill permanently increases the amount of the child and dependent care tax credit from 35% to 50% of qualifying expenses. The credit rate phases down for taxpayers with adjusted gross income over $15,000. It will be reduced by 1 percentage point, but not below 35% for each $2,000 that the taxpayer's AGI exceeds $15,000. It will then be further reduced by, but not below 20%, 1 percentage point for each $2,000 that their AGI exceeds $75,000. So good news for parents and their kids. Again, something I'm excited about, with one on the way again here at the end of this year.
Yes, sir.
Last but not least, children's savings accounts, and I think they're actually calling them Trump accounts. So this creates a new savings account, which is pretty much classified as an IRA for children, with a one-time deposit of $1,000 from the federal government for those people born from 2025 through 2028. So contributions can only be made in calendar years before the beneficiary turns 18, and distributions can only be made starting in the calendar year the calendar year the beneficiary turns 18. So eligible investments in these accounts would generally be mutual funds and indexed ETFs, it sounds like. And contributions will be capped at $5,000 a year. And that's separate from other qualified rollover contributions. So that's something that is interesting, and I think could do a lot of good for a lot of people, because if you think about it, if you have, $1,000 from year one, and by the time you get to age 20, that $1,000 is growing at a compounded annual growth rate of, let's just call it, 7, 8% on the conservative side.
Yep.
And then you're making contributions, or your parents are making contributions to that. That could be a really nice little nest egg for people to help pay for college, or help buy a car, or put a down payment on a home. So again, and that benefits to parents, and those having kids from now through 2028.
I think there's two sides to this. A lot of positives, I think, for the average American, and getting some additional relief from a current taxation standpoint. And then on the flip side, it's no surprise, while we're going to even add more to the deficit, because revenue will go down on the tax side.
Right, exactly, which, is an ever-growing problem. This bill does not make that better. So that's eventually it's going to come home to roost at some point in time, right? But we've also been saying that for the past 10, 20 years. It's just,
Yep.
When is that uncle point?
Yep.
Will be interesting. So I know that was a lot, but I wanted to get that out there in front of everybody. There's a lot of pretty good summaries on it by this point in time. All you have to do is just a quick Google search. So
Yeah, I know Taylor will probably dig into it too at the firm. Might have her on a future podcast over the next month, and I'm sure she might find some additional insights to either the topics you mentioned or new ones as well.
Yeah, agreed. Well, thanks everyone for tuning in and listening to episode 308 of the Independent Advisors podcast. We will be back with you next week for episode 309.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.